Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Alfonso Peccatiello, editor of the Macro Compass.
And today Corey and I will talk about Nvidia and Fed funds futures.
And remember, if you want to get in touch with us, send a note to feedback@investorhour.com and tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. Let's talk about, and we have to talk about Nvidia. First of all, we decided that I don't know how to pronounce it, or one of us does. If somebody said Nvidia, somebody said Nvidia, I said Nvidia, whatever.
And then I said the N is silent, and we'll just call it Vidia.
Yeah, Vidia. There you go. All right, so Vidia went up a bunch on Wednesday. They had a good earnings report, and they projected a huge increase in second quarter sales. First quarter sales were up, but what was it, like 16% or something? And second quarter sales, they said, would be 11 billion, which year over year for the quarter is like 60% or something. It's huge. It's some huge amount. So, the stock was up like 24% the next day. And there are all kinds of good little bits in the news about how much that is. It's like, I think it's more than Adobe. They added more than the market cap of Adobe. 184 billion in market cap was added. Actually, I'm sorry, it was added on Thursday. So
yeah, it's one of the biggest moves in U.S. stock market history by market cap. Yep. They're now the fifth largest American company by market cap, just after one day. A couple minutes. So,
bigger than the market caps of Texas Instruments, Intel, Qualcomm, and Applied Materials. Bigger than each of those. Just added on in one day.
Right. I guess the question is, what does this, what does this mean? I'm sure you have some thoughts on that.
Well, yeah. I mean, I couldn't help noticing the term AI 15 times in the press release, and the founder and CEO Jensen Huang said that basically every company in the world is using AI, and that the chips that Nvidia makes, somehow enables that. And so that's why they're seeing this big bump in sales, and it's going to be even bigger in the second quarter. So, that means that the company is worth 145 times net income, trailing net income, for some reason. I don't know. Maybe you can tell me.
Well, no, I can't really tell you, other than, to me, this was kind of the opposite of what we saw last year in the markets, when after certain tech companies reported earnings, they went down 20% or double digits. I'm thinking of Netflix and Meta. It was the opposite. It was everybody was frightened, and things were going down. And now this to me is like, all right, now we're talking about AI and chips and a stock going up 25% in one day. I mean, this tells you just there's still juice left in this market. As you've been saying, like, this bubble, there's still there's still flickers there, and this is a pretty big flicker. This is like a flame going pretty high, and so
quite the flicker.
Yeah. I mean, I have no doubt, like, there's going to be increased demand for these chips, for AI, and some of them are power, like ChatGPT, which has become a mainstream popular kind of word for AI, basically. And so, yeah, when you're throwing these things around, like, we're going to increase supply to meet the demand of AI, okay, this is going to get some attention. But you mentioned the valuation is a bit much. I think anybody would agree on that, even the people that are benefiting from this right now.
I was curious about Nvidia. I never looked at it very hard. So I thought, well, let me go look and see how rapidly everything is growing. But stuff is shrinking. The operating margin peaked in like 2018, and it's down from like 30. I, I should have these numbers in front of me. I just call everything off the top of my head. 30 something, 35% or so, and now it's like
Yeah, we get it.
15%.
We get the point. Yeah, we get the
Yeah,
idea.
and I just and trailing 12-month revenues, second straight quarter of trailing 12-month revenue decline. Um, Net income is like from something like 10 billion to now it's like 4 billion. I don't get why it's worth 145 times earnings. And I mean, I'm not long the stock. I haven't made a ton of money on it. So, you know, you can say, well, you're complaining and you missed one of the biggest, run-ups in history, and you'd be right. I'm not, I've made other good calls, but I certainly missed, things like Nvidia, because I just don't get why it's worth so much, and it reminds me too much of Cisco. Like I'm a victim of my memory, I guess. It reminds me of Cisco trading for like 200 times earnings, 200 times net income in 2000 at its peak, and of course that thing is still 25% from its all-time peak. It hasn't gotten there, hasn't broken even with that. Even if you add in the dividends, it's still 25% from getting back to that peak. So I feel like this is the same thing. Like I don't doubt that AI is huge, right? AI is a huge development. It could be on par with the internet itself. But as an investment proposition, we have seen these no-brainer, this is the next big thing picks valued at, astronomical valuations go wrong for decades before. So I don't know.
Yeah, I would say, if you own some shares, now would be a great time to take some profits on it. You're not gonna how many more days are you gonna get 25% gap ups and overnight? So it's if anything, enjoy it if you own it, and enjoy it if you own it. I like that saying.
Yeah. Enjoy them if you own them.
And actually, this reminds me, our friend Dave Lashmit was one of the early ones to pick Nvidia. He doesn't have it in the portfolio anymore because he sold out at a higher, I think somewhere around this price, maybe a year or plus ago. And he made, what was it? I'm looking at it right now, almost a 1,500% gain in one of the legs of the positions that he recommended in his model portfolio in Stansberry Venture Technology. And he saw it, what you're talking about, when it had the potential to grow, and this was years ago, and not at this point now that you're talking about. Maybe things are actually slowing down for them a little bit. So,
Yeah, you're
um,
right. Dave did the thing that I failed to do. You're right.
yeah, yeah, okay, yeah. But I mean, your point is. But now we're at this point, like, okay, 100 and what did you say, 145 times earnings?
Thereabouts. Yeah, that was like a
Yeah,
day or
I mean,
so ago, but yeah. Yep, 125 times net income. It's like saying, if you bought this thing, the whole thing yourself today, you'll get your money back out of it in 145 years. You know? Doesn't seem
yeah,
like
I
a
will
good
say,
bet.
the buzz around AI right now reminds me of all kinds of other buzzes that we've seen in the past, and so yeah, it's not a. If anything, maybe it's more of a sign of that, and to me, it's more of a sign of, you know, like, if you want to take this out and make it into like a macroeconomic discussion, it's a sign that there's still just or that there's growing risk appetite now for growth stocks again. Um, which again, I think may play into the whole. Maybe we're going to talk about this next, the Fed story and the interest rate story, and whether they're seeing enough out of the market right now that that they're happy with. Jerome Powell's never going to come out and say we don't want the stock market going higher, but when inflation's at 40-year highs still,
Mhm.
and you've been raising rates like you haven't since the 70s still, and you got a stock going up 25% and becoming top 5 market cap. I mean, what does that tell you if you work at the Fed?
Yeah, and well, it tells the futures market something, doesn't it? Because they have these Fed futures contracts that are basically they expire on the date of the Fed meeting when they make the announcement. So the next one expires June 14th. And I'm telling you, I've looked at this contract for a little while, and it was like 80% probability that rates would stay unchanged at that meeting. And then, a high probability that they would stay unchanged for another meeting or so, and then be cut in July or September, the next two meetings. Now, as we speak, I'm looking at the screen, and the FedWatch tool that looks at this says there's a 58.5% chance of another 25% or 25 basis point hike at the June 14th meeting. It has never said that the higher probability was a hike until now. And then you go to the next contract, which is essentially the next meeting in June, and it says basically the highest probability is that same range. So it's saying, hike in June, stick in July, stick in September, and then the probability of a cut back 25 basis points is highest in November. So it's all getting pushed out. Before it was a probability of a cut in September. Now it's a probability of a cut in November. What's it going to be a month from now? December, January 24, March 24. You know what I'm saying? It just keeps getting pushed out, much like inflation and interest rate expectations themselves, right? We started out transitory. We started out with, supply shock, transitory, pandemic. Then we're like, oh, higher for longer. And now we're like, whoa, you know, core PCE is just really, really sticky. And here we go. Here we go with inflation and rates higher for longer.
Yeah, I'm having deja vu to last year when the same behavior. I saw the same behavior in the bond market, the Fed futures. Um, it was the same thing. It was literally the same thing. Nobody was expecting the Fed to go as high as they did, and then a week or two before these meetings, you saw these bets change, and these are big. Okay, this isn't like out of thin air, just speculation. These are $5 million contracts, a Fed funds futures. So this is like big money, and so that's why I pay attention to these, because you're not gonna. I mean, you're taking on some decent risk here, and so the people who are trading these, and so um, yeah, it's worth paying attention to. I kind of noticed that too yesterday or Thursday. Last week Thursday was the first time that this market started pricing in another rate hike, and you just wonder when is that. And the bond market's typically ahead of the stock market on these things, so you just wonder what's next ahead for stocks. It's making me a little setting off my spidey sense a little bit, because I'm just remembering last year, whenever we saw these type of moves in terms of expectations for interest rates changing, uh, the stock market didn't really react on it until it happened. From the Fed, you know, there was big moves when it actually happened, and so if they do raise rates in June, there's going to be a lot of volatility around. People are obsessed with the debt ceiling at this point, but I think this is a bit more of an important practical story uh,
Right.
to think about. Yeah.
Yeah. They're obsessed with the debt ceiling, and that could be over in a minute. I mean, that could be over in a heartbeat, right? And we don't
Yeah,
expect that to go on long at
right,
all.
right. I'm of the belief that if they wanted to end that right now, they could. Which is
Yep.
why Congress has enjoyed the Memorial Day weekend as much as hopefully you and I will. But
Yeah.
but they could sign this thing. Could have signed this thing last week and have it done, but we'll see.
We will see. And I think actually your point is right. The big narratives are debt ceiling. Um, that's sort of taken over everybody's mind right now, and all the headlines and everything. Like, you can't not read about it. If you want to read the Wall Street Journal or Bloomberg or Financial Times, whatever it is, you absolutely must read the words debt ceiling to get to whatever it is you're trying whatever else it is that's unrelated to that you're trying to read. So so you can't escape it, but it truly is a transitory phenomenon. Like even if they go too far and drag it on and drag it on and stop making payments and cut discretionary spending and all that, those things. We know they won't cut debt payments, so they'll do something before it gets to that point. Um, but no matter how bad it gets, you're so right to point out that the real issue is this: interest rates, persistence of inflation, and impact on markets.
Yeah,
As usual, the
you look at the
go ahead.
bond yields the last couple weeks, um, they've gone up a pretty significant amount,
Mhm.
from across all the different durations, and the yield curve's gotten actually inverted a bit more. If the 10-year, 2-year comparison has got inverted more back to what it was in March, right when at the onset of the banking crisis. Since then, things have gotten a little better because people were expecting, the Fed won't want to do more harm, but it seems that sentiment is passing, and we're getting into a maybe they'll hike more thought process, because I think this is important too. I've been reading the Fed speak lately, and the different Fed officials have gone on TV saying they're changing the language from a possible pause to a skip. Meaning, so instead of pausing, which implies apparently the Fed decided they don't like the word pause anymore and have moved to skip, because pause implies that you won't raise rates anymore, but skip implies that you could raise rates again. So I think that's playing into this story too, with what we're seeing in the bond market and the Fed futures.
All right, Mr. Fed speak interpreter, let me ask
There you
you.
go. I didn't even use the Dan
Yeah,
Ferris
yeah,
publication that we came up
that's
with a couple weeks ago.
right, right. The rating each sentence hawkish or not. But let me ask you then, like, are they are they trying to condition us for higher for longer rates, or are they conditioning us for something else? Because it sounded to me like they're trying to get us used to the idea that rates aren't going down anytime soon. Like when they switch from pause to skip, that tells me something. They're like, let's just change the wording here a little bit. Let's just get them used to the idea that nope, not cutting.
Yeah, I think they're trying to get that message across, that that's their thinking, that we're not going to cut this year at all. Which is what has been. I don't know. I guess enough people in the market have still think that, and so I don't think either one of us thought that, unless a recession, you know, really requires it. That a sort of deep recession requires it. But even then you're
Yeah.
sacrificing inflation. So yeah, I think that they are trying to get the message out now. I believe
Mm.
that we could, like, our base case is not cutting rates anytime soon. If
Mhm.
anything, raising them. And if we don't raise them in this June meeting, we might raise them at the next one.
Yeah. Yep.
So
Could just be a skip. That's right.
I know, hop, skip, jump. We got all the. Yeah, it's wild. Yeah,
Right. So basically, the era of zero interest rates is finally over, and all the implications of that are unwinding. And I'm sitting here looking at a Financial Times article that is called "U.S. Credit Squeeze Triggers Rise in Corporate Bankruptcies," and then it says Chapter 11 filings by indebted companies jump in May, including 5 during a 24-hour span. And just a little quote from the article: 8 companies with more than 500 million in liabilities have filed for Chapter 11 bankruptcy this month, including 5 in a single 24-hour stretch last week. In 2022, the monthly average was just over 3 filings. 27 large debtors have filed for bankruptcy so far in 2023, compared to 40 for all of 2022. This is the bleeding edge of we're wiping out the zombies, right? We've armed the population with high interest rates and they're wiping out the zombies.
yeah. It's yeah. As you're speaking, I'm thinking, all right, this whole timeline is just getting pushed out a bit more to of like when the when the Fed may stop this quote inflation fighting and rate hike cycle and all of that. I think this whole thing has just gone on longer than people have thought, and the trends. If I've learned anything since paying attention to the markets, that's that trends can go on longer than you would think, and so until we see signs of that changing, I mean, inflation, like you mentioned, is still high. Where the latest PCE number, still high, which is the one the Fed pays attention to. So yeah, I just, and at the same time, you're seeing spending, American consumer spending still up there, but a lot of it being more of it being put on credit cards, which tells you that people are feeling pinched with higher prices, and so I don't know. We're headed into that point. What you're saying, but we're not there yet, and so I don't know how higher the Fed wants to go at this point. Maybe this stuff turns around back again soon to what the expectations were 2 weeks ago, but kind of shows you how close we are to higher rates rather than lower rates.
Yeah. Well, we have a lot of questions about this. I think we should probably ask them to someone who thinks a lot about them and has written and spoken a lot about them recently. His name is Alfonso Peccatiello. We all know him as Alf, and I follow him on Twitter. You can probably just type Alf into your little Twitter search window and find his feed there. And we spoke with him recently. He had a lot to say, and let's listen to that. Let's do it right now. With gold having recently hit a new all-time high, my viewers are wondering what's next for the price of gold. To answer this question, my colleague Daniela Cambone is sitting down with two of the smartest gold experts in the world for an exclusive new interview. In it, you'll hear their prediction for where gold is headed next, the good news and bad news for gold investors today, and perhaps most importantly, you'll get to see the inner workings of a powerful system for investing in gold, a system which has delivered audited returns of 706% for more than 2 decades, crushing the return of gold, the returns of major gold funds, and more than doubling the S&P 500. To be among the first viewers to see this exclusive new interview, head to www.goldrush23.com to sign up for a reminder of when we go live. Again, that's www.goldrush23.com to sign up for a big gold interview. Alf, welcome to the show. Thanks for being here.
Hey, Dan, it's a pleasure. Thanks for having me.
So, Alf, I admit I am a reader of yours, a subscriber of yours, and I enjoy your content, and a follower on Twitter as well. Rather than sort of all the usual, background stuff that we do, I think we have to jump in here. We have to jump into the deep end because there's a topic I know that is on everyone's mind. You can't, like, if you want to read about something else in the financial press, you can't do it. It's just, and that, of course, is the debt ceiling. And you had a few things to say about this recently. And I was most sort of interested in your view of this as a low probability, high severity event. I think that little matrix is really important. I hope our listeners will kind of write that down and make a note of it. Do you use that all the time?
Yes, I do. So then let's try to explain what that is.
Okay.
Before running the macro compass like I do today, I ran a $20 billion portfolio for a large European bank. That taught me a few things. One of it is risks in markets should be measured as a probability they happen and how bad is the outcome if they happen, right? So the debt ceiling, it fits into this part of the quadrant of this model where you say, well, is the US going to default? It's a low probability event, is it? I mean, in the end, they're going to probably find the deal. But what is the magnitude, the severity, the impact on economic growth if they actually do default? It's very, very large, right? And so I think right now, people on the debt ceiling story should understand two things. One is the incentive scheme for Republicans here is to drag negotiations for as long as they can. Biden was very late in taking them seriously. So they started negotiations very late. And Republicans now are probably going to try and drag this for as long as they can to try and get the best out of a deal, right? That's what you do when you have time in your favor. You drag negotiations longer. The problem with that is markets also have another uncertainty ahead of them is, will the government actually have enough money by June to meet its obligations as that negotiations go on? The answer is very uncertain. If I run estimates, the government might make it, maybe they don't. It's very uncertain. So it's two uncertainties ahead of them. Will they strike a deal? Will the government have enough money to actually make payments in June? Now, if you have both of these uncertainties, I think the probability that something goes wrong is a bit higher than what the market is estimating as we speak. And so if you look back at 2011, you have a similar situation. In July, August, we were running into these debt ceiling deadlines. And at some point, all of a sudden, people realized, oh God, maybe we're not going to make it. And then you look at asset classes performance, and gold rallied 25% in 5 weeks. And the S&P 500 went down 15%, 20% in 5 or 6 weeks. And so you start looking at this and you're like, well, maybe investors are underestimating the probability that something goes wrong. They know about the magnitude, but I think they've been too relaxed about the probability so far.
Okay. To me, this is a very interesting viewpoint because I've been of a mind that, politically, it serves absolutely no one to allow the government to, default or miss payments or however they're going to structure that when they have a real problem and don't have enough dollars to make that first payment. It serves no one politically. They all look like idiots to me. And you'd think that if the Republicans are playing brinkmanship with this and bringing it right up to the brink, that they know they're going to make a deal and they know they have to make a deal. So I find it very interesting that you're saying we've underestimated the probability of this. What do you think that first week or those first few days look like? I mean, do we just we're shutting down, public parks and things like that? Or you're not really talking about missing a debt payment, are you?
No, I'm not talking about that.
Okay,
So it's
just
a very
so we're
valid
clear.
question. It is
Yeah.
a very valid question then, because the other thing we need to make clear is I think they're going to find a deal in the end. What does the end means? Well, it might be mid of June, the 20th of June. It might be a couple of weeks where it's very unclear what the government is going to do. And so markets, which were extremely calm going into the event, I think had the chance to reprice the probability, the uncertainty higher. And they are doing that as we speak. I mean, the S&P has lost already a couple of percentage points and so on and so forth. What happens if actually there is no signed deal and at the same time the government runs out of Treasury General Account money at the beginning of June? The government doesn't default. The government prioritizes payments at that point. So on June 12th, new money comes in from a new round of tax receipts from the government. So the government does have money. The problem is that the government cannot do deficit spending. So it needs to prioritize where it spends money because it can't issue bonds to fund deficits in the meantime. So the government has some money. And generally speaking, I would expect the government prioritizes debt payments. So then I agree with you. The government will not default. The political costs and, in general, the financial markets would be completely rattled if they let that happen. But think with me, if the government has to prioritize payments and it does prioritize debt payments and debt servicing, then all other discretionary spending is going to receive a cut. My estimate is that government discretionary federal spending is going to move down by about 30%. So a third of discretionary spending needs to be cut to prioritize payments. Even if you do that for a few weeks, it's not great for growth, is it? So the market is then going to be forced again to favor the defensive assets, bonds, gold, rather than equities and more offensive assets. And that, I think, it's, again, not a negligible probability. And that's how I see the debt ceiling. Ultimately, they will find a deal. I think the Republicans at that point will have applied, I think, enough pressure, maybe destabilized the economy a little bit heading into 2024. And then you're right, they don't want to be seen as the guys, leading to a disaster. Nobody wants to be pictured as one, but they can create and they can destabilize and shuffle around quite a lot before we get there.
And I also I want to say that I realize there's a kind of a counter narrative too, which is that you can say, well, we tried. We tried to have discipline, but the Democrats wouldn't let us, or something like that. So I'm aware, it's a more complicated issue than that. But in the end, I don't think a lot of people would see it that way. So let's talk about that 30%, because see, I've been probably slower than most. I'm always late to the party, but I've been slower than most, kind of giving up on the idea that a recession is imminent. But 30% cut to discretionary spending, with the U.S. government, with all the money they spend, that would send us. That would change my viewpoint. I think it would have to, right? I mean, we'd be there pretty quick, wouldn't we, in a recession?
Yeah. If you cut discretionary spending by 30% for 4 or 6 weeks, the estimate is that both Q2 and Q3 GDP will be negative as a result. The impact is large. I mean, government spending accounts for a lot of GDP creation in the US. Government deficits are very large. The government injects a lot of money into the economy every year in the US, a bit more, a bit less. During the pandemic, we went ballistic. But it is an important driver of GDP growth, and so if you reduce that by a lot, even for 4 to 6 weeks, that might actually send us in a recession. I think it accelerates already the negative growth impulse we're having in the US, because then you talked about giving up on a recession. It's been very frustrating as a macroeconomist or an investor to navigate this period, because we were at some point in October last year where it seemed increasingly clear that the recession was just about to hit at the beginning of 2023. And, slowly but surely, you realize the direction of travel is right. Yes, the economy is weakening, but US GDP growth trends are roughly in the 1% real growth area as we speak. So, earnings are negative on a year-on-year basis. So company earnings are coming down. That's generally not good for growth, and it bodes towards a recession. But on the other hand, consumer spending, the services sector, the labor market are holding on relatively well. I mean, they're not recessionary as we speak. So the confluence of all factors makes for a below trend US growth, but not a recession yet. That's been frustrating to many that expected a recession to hit already. If you get these discretionary cuts to federal spending, then I think you get quite a boost to the recessionary cause, because the economy is fragile. The growth trends are weak. And then in that case, you would basically add another layer of complexity and probably in the end send the economy through a recession.
Yeah, that would not be any fun for anybody. Well, let's see. Where are you now on this? Like, are you, as an investor, um, it's kind of a difficult moment, right? Because, people want to flee to safety, and they want to flee to safety in treasury bonds. And, if you're pricing in this, admittedly extremely unlikely event, you might avoid doing that. Without giving away any of your secret sauce, I know you have subscribers who pay for your secrets. What does one do at a time like this?
So then, as an experienced macro investor who has made a lot of mistake in his career as well, I learned that it's easy to scream on a podcast, buy this, buy that. But in reality, investors always have to have attackers and defenders in their portfolio, because ex ante, you never know exactly how it's going to play out, right? So this is how I'm looking at the world right now. If you're looking at having some exposure towards good growth, you normally buy equities, right? That is the asset class, stocks that performs the best if the economy is doing fine. I don't like US stocks that much as we speak, because the Federal Reserve has been raising rates for a while. It will keep policy very tight for a long period of time. Valuations are still relatively expensive. I mean, the S&P forward valuations are about 19, 20 times earnings. I mean, it's not cheap from a risk premium, from a valuation perspective, and there are quite some macro clouds ahead. But if you look outside the US, you can still have some attackers in your portfolio. Look at Japan, for instance. Japan has been a place which was massively underinvested for years because nobody was interested in a story that there is no growth. There was no growth in Japan. Fast forward to today, though, there is growth and there is inflation. So nominal growth is picking up, wages are rising over 4%, and the new governor at the Bank of Japan doesn't seem to be in a hurry to raise interest rates. So what's happening is that he's end up stimulating this growth even further. And these Japanese equities are valued at very reasonable levels. Price earnings ratio of 8, 9, not 20. So you can actually get some good exposure there. You look at some emerging markets, another underinvested place over the last 20 years. And this Latin American, this Brazilian, these Mexicans, but also Eastern Europe is doing well. Poland is a great place where to invest. So you don't necessarily have to have US equities. You can look a little bit around, I think, especially in this cycle, and have some equity exposure. Then you need defenders, right? And the defenders at this part of the cycle are two mostly, I would say. The first is gold, that both in that ceiling uncertainty, like in 2011, did very well, but also, generally speaking, when the Fed is done hiking rates and there are macro clouds ahead, generally having an allocation to gold helps preserving wealth in your portfolio. And the other, obviously, is bonds. Now, bonds here, of course, they are a bit affected, especially short-dated bonds. You see that these T-bills yields are going to 6% because people are uncertain. Will I get paid? Maybe I need to wait a month more to get my money. So I want to, price in that uncertainty. I demand a lower price to buy these T-bills. But long-end bonds, then 30-year bonds, 10-year bonds, those actually are reflective of economic conditions, growth and inflation over 10, 20, and 30 years. So if you think that the Federal Reserve cannot keep interest rates at 5% forever, if you think that by keeping policy tight until something breaks, you actually manage to break something at some point and the Fed will be forced to cut rates, then buying long-end bonds will protect your portfolio against the drawdowns. So these are the defenders I like, long-end bonds and gold, most importantly. And you cannot have a portfolio only skewed to that. You always need to have a balance. And so for the attackers, instead of looking at the US, I think people have to look broader at the world in a broader sense, because it's not only the US, guys. There is a lot more out there that still is at reasonable valuations with a good growth story, like Japan, like other emerging markets.
Yeah, I like Japan too. Long bonds, huh? Wow, that's I think some people would call that a gutsy call right now.
Well, I always wonder something. So the US economy, looking at government debt and private sector debt together. So not only the government, but also US households, US corporates. Let's look at the debt of the entire US system. We are running at about 270, 280% of GDP in the US. So you can say the US economy between the government and the private.
Oh, total. Okay.
Total debt is leveraged about 3 times. Okay. So between the private sector and the public sector. Has something really changed then that makes the ability to produce cash flows, earnings, salaries, has that really changed from before the pandemic to today? I mean, demographics is what it is. Productivity trends are what they are. We become an older economy as we go, right? If that hasn't really changed, the ability that the economy has to generate strong growth to pay this debt has not really changed that much, right? So what we did in the past is we made sure that interest rates were lower. That's how we engineered. That's how we kept the system afloat, right? That's how the system can be levered 300% to GDP in aggregate between private and public sector and still function. Because every time we wanted to indebt ourselves more, we just allowed ourselves to do that at lower interest rates. Mortgage rates in 2000 were at 8, 9, 10%. And they were all the way down to 3% in 2021. I mean, it's easier to lever up if your mortgage rate is very low. It is much more difficult to sustain high debt levels if corporate borrowing rates are higher, if mortgage borrowing rates are higher. Even for the government, if the government needs to, pay 4 or 5% interest rates to get that on, it's more expensive to do so. Unless you have stronger cash flows, stronger growth, stronger structural growth drivers, the system doesn't hold well with interest rates being that high. You can see that already in the mortgage market then. I mean, these commercial property prices, housing prices are declining already. Why? I mean, mortgage rates are 7%, guys. No, it's not easy to afford the median house price at today's mortgage rate. It's too expensive. So the system is not in equilibrium anymore then. And this is why I think to balance it back, you need again lower interest rates. The Fed can't lower rates as we speak because inflation is too high. So they will force interest rates to remain high. But the longer they remain high, the higher the risk that the system breaks, that this equilibrium is very fragile and it needs to break. And when it does break, then it does a lot of damage to the economy. And then ultimately, the Federal Reserve needs to cut rates. In every recession, the Fed cut rates by 300-400 basis points. I really don't see why this time would be different, especially if something serious really breaks.
Right. And I noticed, well, you can see it other places too, but in like Fed funds futures, they were discounting, no change in June and July, and then in September, an actual 25 bips cut. And now I think that cut is pushed to, what is the next one? October, November, whenever it is.
Yeah.
And even just no change is pretty hawkish. It sounds like you're saying as well. I mean, no change at all. That's tightening, right? If you don't cut, you're effectively tightening at this point.
You're totally right, Dan. And this is an important concept for our listeners to understand. There are two sources of tightening policy. The first is when you move rates from 0 to 5. Whoa, that's tough because conditions change really rapidly. And so all these overvalued tech stocks and unprofitable tech companies, they need to get repriced because, ladies and gentlemen, the era of 0% interest rates is not there anymore. So all your valuations need to be repriced down. And we have seen that happening in 2022, right? That's the most intuitive source of tightening. Everybody understands moving from 0 to 5 is very, very hard. A lot of people underestimate the power of keeping rates at 5 for a long period of time. Because that means that the people, that the companies, the households that were immune or that handled well the first iteration, so the rate of change, the tightening impulse, the ones that handled that well are now faced with tighter for longer policy. So let's take an example. Let's say you are a highly indebted corporate in the US, one of these junk zombie companies out there. You survived and you did okay between 2014 and 2021 because your borrowing rates were very low. Quantitative easing, 0% interest rates, credit spreads were tight. So these companies could borrow at like 4 or 5%, okay, despite being junk zombie companies. All right. Now you get a jump in borrowing rates. Today, junk corporates in the US have to borrow at 9 to 10%. Okay? But let's say they were smart. Let's say in 2021, then they borrowed a lot because interest rates were really low. So they front loaded some of their borrowing needs to 2021. Okay, so comes 2022, there's a sharp repricing. Yeah, but they don't need really to borrow, right? They can wait. They got their funds. They were smart. In 2021, they got their funds. Okay, so 2022, they suffer, but they come relatively unscathed out of it. First half of 2023, we don't borrow, rates are not coming down, we just wait a little bit longer. Then the economy weakens, then sales start coming down. Then you're looking at the second half of 2023 and you're like, I need to access capital markets at some point. I need some bank loans at some point to refinance my business. So the longer these tight conditions last, the more likely it is then that some of these dominoes will fall. You don't need rates to go to 7-8% and continue going up for tightening policy. If you keep rates at the high level for a long period of time, you're achieving the same mechanism. It's just more boring. It gets less headlines in the newspaper, but it is happening under the hood. The fact that mortgage rates are sticky at 7% for a long period of time means that the housing market will be frozen for a longer period of time, which increases the chance something goes wrong. You see already KKR, Blackstone, all these large real estate investors, they're freezing redemptions from the real estate funds then. If you want to get your money out from a Blackstone real estate fund, I have a news for you. You can't. There are monthly gates to redemption. So you have to wait and you can only get out a small amount. Why? Because they know if there are large redemptions, they need to sell a lot of properties into the market where are the buyers with mortgage rates this high? So it's a very precarious equilibrium. And the longer you keep these conditions tight, I believe the higher the chance that something goes sour in some place. I can't predict where. Regional banks, the real estate market, it can be some other credit market. We don't know exactly where, but there are cracks appearing. And the longer you keep it tight, the higher the chance something goes wrong.
Alf, I'm glad that you mentioned the effect of 0% rates for so long, because the pandemic did this to me too. The effect is so huge and it's ubiquitous. It's everywhere you look. So you get used to it and you don't see it anymore. And I'm beginning to realize the degree to which, the pandemic has affected things. And then I look and I think I'm seeing one effect, but then I think about the pandemic and I think, well, no, maybe it's different or something. And I think 0% rates are like that. And I feel like 0% interest rates, it's like the most dramatic, completely transformative thing that ever happened to the global economy. The more I sort of step back and I step back and I step back, I feel like, wow, you mentioned Blackstone, but I was thinking about BlackRock recently. And I wonder, like, would they have whatever it is? I think 8 or 9 trillion or something, whatever's under management, or 7 or 8, or I don't know what it is. It's trillions and trillions of dollars under management. I think, well, would they have gotten here without, they're selling ETFs and index funds and things. Would they have gotten there without 0% rates? And what happens on the other side of 0% when we get higher for longer? Is there an effective run on their AUM? And I wonder about the effects of that. And I feel like I'm only just beginning to have an awareness of it. Do you think there's like super long-term consequences for 0% rates for all that time?
Yes, I think we have made the incentive schemes wrong for the private sector. So we have encouraged unproductive behaviors. And look, let's make a simple example. In Europe, just to change a bit the paradigm from the US to Europe, in places where the access to credit was very readily available, take Northern Europe, like, these countries are like the Netherlands, they are much more easy with giving credit to people. A lot of people could access extremely cheap mortgages. In Germany, third-year mortgage rates were below 2%. Now imagine that, 1.5% third-year mortgage. This lasted for years and years and years on end then. So a lot of people actually did become millionaire by simply buying a house. Okay, so what does that do to the productivity of these people? What does that do to their willingness to participate into the labor force? It doesn't do much because, by simply accessing leverage and cheap credit and by riding the asset price boom, they are done. And so this is one of the many wrong incentive schemes, I think, that we gave away. And this lasted for years. You have to walk back. Now it seems like a distant past, but you have to go back not that far away. You have to go to 2019. I mean, European banks were faced with negative interest rates. So that meant they had to give credit to anything out there then, because otherwise they were losing money. I mean, a bank is not in the business of losing money. They want to make some money. So what happened? They loosened their lending standards. They did the so-called covenant light loans, which is a lot of jargon for I'm not going to check you out. I'm not going to check how indebted you are. I'm not going to check your fundamentals. Please take my money because I need to make some loans. Otherwise, I'm going to keep losing money on my negative risk-free rates. We gave really, really wrong incentive schemes. And now I think you're right in the sense that we are reversing that. So we had a big cleansing in 2022, I think. I mean, look at some of these IPOs and SPACs and all these, highly frothy kind of markets. They were down 90% at some point. So we had a proper cleansing of that. But still, I think we're still facing a pretty large tail of businesses and behaviors that flourished during this zero interest rate phenomenon and that were kind of unscathed, or they managed to handle 2022. But if I look at the persistence of this high interest rate policy now, I have to worry, honestly, that all these unproductive behaviors, zombie companies, I think they are bound to suffer at some point. And I don't think it's a linear process. I think it's rather a one-off event. It's a Minsky moment where we realize, oh, we still had a lot of dust under the carpet. We didn't see it coming. We thought it was okay. We thought something was different, that the economy could handle. In the US, 5%. In Europe, we're talking about 4% interest rates. 4% risk-free interest rates in Europe, a place that had negative interest rates for years on end. I have to honestly be worried about the persistently high interest rates, what that does to unproductive companies and weaker balance sheets out there.
Yeah, well, we know what it's done to some banks, don't we?
Yeah.
We know it wiped a few of them out because they had the confluence of, being a financial plus being really exposed to the not zombies necessarily, but cash burning, tech companies, let's just call them. And it just created a horrible situation. But that, lately when I just, glance at regional banks and things, they seem to be kind of coming back, and it seems to be, are we beyond this? Maybe it's over.
So for the banks, I proud myself in having sent an article on March 10th, I think, which was called Order, Please. And the article was, guys, let's try to see what's happening here. And the analysis was there are some very weak links in the US, poorly regulated banks, loosely regulated banks that acted like cowboys because they didn't have tight regulation to stick to. And so they're poorly run, terrible risk management, and they're going to blow up. The rest of the banking industry, though, is not going to get affected by this that much. Okay, this turned out to be the correct take, but we are now in the second stage of the problem then. We have moved, I think, from the liquidity stress, higher interest rate, what is this going to do to these treasury positions of banks? I mean, the Federal Reserve has created basically a backstop facility, you can say, for the emergency problem of, oh my God, my bonds are worth 70 cents on the dollar, and I'm going to be forced to sell them because deposits are going away and I need to service these deposits. So I need to sell my assets. I'm going to blow a hole in my balance sheet and my capital is going to be wiped out. And now you don't need to do that anymore. You can just give the bonds to the Federal Reserve through one of these facilities and they'll give you the funding. And they'll give you the replacement for these deposits going away, in other words. It's an emergency backstop facility. It has worked, I think, to reduce that risk. But we have another problem. Deposits keep going away because of a reason, because people can get a 5% risk-free rate today. They don't want to get money parked at 0%. So slowly but surely, deposits go away. If you're a bank and you need to consistently replace deposits, you need to go to the market or to the Fed or somewhere else. And the cost for replacing these deposits, you need to pay market rates. Market rates are not zero, they're 5-6% if you're a bank. Now, that means that the net interest margin, that means the profits these banks can do, obviously shrink pretty aggressively. Now, this process takes time. It doesn't happen overnight. It doesn't cause insolvencies overnight. But this process of compressing margins for banks, together with deteriorating asset quality, because that's what we're moving to now. We're moving the focus from liquidity to okay, you guys made a lot of loans to unproductive businesses in 2017, 18, 19. You're full of commercial real estate exposure. You're full of, not great credit quality exposure. What about the asset quality of your bank loans? And we're shifting the attention to that. And generally, again, that is a slow-moving train wreck, a bit like the compression in margins. That's why, again, this is another story. It's not going to be something for big headlines tomorrow, but under the surface, then you need to understand that the banking system is deteriorating, both because of the compression of margins and because of the credit quality of their assets, which is deteriorating. When is the bad news going to hit? I don't know. I don't have a crystal ball, but I know there is a process underlying which is weakening the bank's balance sheet. This is one of the reasons why, again, I think having defensive assets in the portfolio is the right thing to do right now. You don't know exactly when something is going to break, but the probability that something break increases over time the longer the Fed keeps policy this tight.
Something breaking, meaning worse than 3 banks going under?
Definitely. I mean, again, it's if you look at other episodes where something broke,
Mhm.
even when the inflation was 2% and the Fed could pivot very easily. I mean, in 2018, you got the equity market drawing down 15-20% in a few quarters, actually in a few months. Wow, that was pretty sharp. In 2019, you got the repo market crisis. I mean, we're talking systemic stuff here. In 2000, you got the dot-com bubble breaking. That was a very, very large bubble that actually broke down. And then in 2001, we got a recession. 2008, we got a global financial crisis due to the housing market breaking down. So, in principle, yes, we could get one of these very convex, very vicious deleveraging cycles. The reason why I think that is possible, and I don't know exactly in which corner is going to pop up, is exactly what we discussed before. Zero interest rate policy led to excessive risk taking, led to these unproductive behaviors. And as we were looking to generate returns because interest rates were negative, regulation was loosened and banks took more risks and shadow banks entered the stage. And credit, actually, the availability of credit was provided not by banks, but by shadow banks, by other operators in this financial market. There are layers and layers and layers of leverage then. And generally, leverage is okay as long as growth is fine and interest rates are very low. And today, growth is deteriorating and interest rates are not that low anymore. And the combination honestly makes me a bit worried at this stage.
Yeah, I've started to wonder about shadow banks too because it's, it's a typical term that scares people, but it takes in a lot of different types of institutions. I mean, I mentioned BlackRock, effectively, you could say they're the biggest one of all. But there's a lot of other folks who are it's completely private. They're not regulated like a bank at all, and yet they're making exactly those kind of loans and other bank-like services. How does an investor get a handle on that? Get an idea of what is going on there? Like, do you have to live in New York and know everybody in town? I mean, I don't
Yeah,
know.
it's very hard because of the lack of regulation of the shadow banking industry. That also means that getting data on the shadow banking industry is very hard because they don't need to report much, right, on their credit activity. And also, they don't do standard lending. It's not like they produce bank loans, but the way they provide credit is by having collateral, so mostly treasuries. These companies have treasuries on their balance sheet, and then they use the treasuries as collateral to give credit away to the markets, for example, to other market participants. So it's not easy, honestly, to keep track of that. At the Macro Compass, I actually have some instruments that try to proxy what's going on at the overall credit perspective at the economy. So that takes banks, that takes capital markets, that takes shadow banks, but it is a very complicated market. It makes use of the so-called Eurodollar market a lot as well, where basically you use safe collateral like treasuries to be able to get or provide credit to other institutions. And honestly, it's what I always say. The Fed worries about the credit markets they can track very closely, but there is a gigantic market outside the Fed control out there, which also expands beyond the borders of the United States. I mean, the Eurodollar market allows entities that are not in the US to use dollar collateral to produce loans denominated in dollars. I mean, that's very scary because these companies, these banks, these shadow banks, the moment they cannot get their hands on the dollars anymore, the moment the economy is slowing down, they have exposure to dollar loans. They have issued dollar credit. So how do they plan to service that? How do they plan to keep this system functioning without being able to go to the Fed and say, hey, I need dollar liquidity? So this system is gigantic. It's very hard to track, and I do my best at the Macro Compass together with tracking all other macro indicators.
Yeah, Bank of International Settlements says there's 12.8 trillion of this outstanding outside the US, dollar denominated outside the US.
Yeah, it's something I've had a look at myself as well. It's over $12 trillion. It's a dollar denominated debt issued by entities not sitting in the United States. $12 trillion. So the first question you ask yourself is, what happens if these companies, these countries, cannot get their hands on enough dollars? What happens if global trades go down? What happens if commodity prices move down? What happens if asset prices move down? And basically, if the economy slows down. If I am a Brazilian corporate and I borrowed in dollars, I cannot go to the Fed and say, hey, I need some dollar liquidity, please. I need this hard dollar cash flows. And so you have an entire gigantic system out there of dollar debt that the Fed cannot control or influence, actually, if not with swap lines with other central banks as an emergency measure. The shadow banking system, the Eurodollar system, something really important to track.
Something really important to track that you can't track. Yay! It's, right? It's really important and we know nothing about it. Yay!
Well, what you can do is obviously you can gather data and proxies like I do at the Macro Compass, but also there is one interesting thing. Markets. All of this is linked to capital markets. So if you know where to look at in financial markets, you can get early warning indicators for potential stress popping up in the Eurodollar market. That you can do. That is what I do as well, given the experience. I worked for a European bank. Mind you, European banks have big dollar credit exposure. They generate dollar credit, but they not always have access to the Fed. And I was in one of these banks. So you have, by being in the trenches, you can understand how a European bank gets the dollar funding. And therefore, you can also track these markets to understand, is there any stress building up? Is there a big demand for dollar because something is going wrong? So banks need this dollar funding. And that's what I do. The Macro Compass, try to track these indicators. But as you say, Dan, it's a very opaque market. The best you can do is try to get a hold of what is happening out there, but it is not transparent. It's not easy to track.
Right. Well, I think that's a good place to end. And before we get to my final question, I did say, at the outset that I'm a subscriber of yours. Where can our listeners find you?
They can find me at themacrocompass.com. That's the website where you can subscribe to my services. What I do there is I basically try to break down developments in macro and markets in plain English so that people can understand what is going on in all the corners of the markets, try to put all them together and also make it actionable with ETF portfolios, trade ideas, because the idea is to put the money where the mouth is, to apply all the macro models, but to come up with something that helps people to manage risks through the cycles. And all of that is on the macrocompass.com.
All right. So my final question is the same for every guest, no matter what the topic. Sometimes we even have non-financial guests, and I ask them this exact same question. It's always the same. And it's very simple. If you could leave our listener with a single thought today, what would it be?
You don't know the future in advance. Nobody does. We always have to think in probability terms, be humble and open-minded to markets. The next 5 to 10 years are more likely to have more macro uncertainty than the 5-10 years before us. That we can try and say. There are so many geopolitical currents out there. Central banks are moving across the place. The pandemic has generated some changes in the economy. So it is more likely that the next 5 to 10 years are going to be more uncertain. The only thing you can do, because you can't predict exactly what's going to happen then, is to study macro, to become a better macro investor. The best investment you can make is always in your own knowledge and learning and understanding macro and paying attention to it and to risk management. So I think that it's very important to say because the last 10 years have been pretty easy for investors. If you just bought some stocks and some bonds and sat on it, you made 10% a year with minimum volatility. Guys, that is not the normality. That was a regime that was there and was prevailing for some reasons. These reasons might not repeat over the next 5 to 10 years. The best investment you can make is in your own macro learning journey and education.
All right. Good answer. Thank you. And listen, Alf, thanks for being here. I enjoyed talking with you.
Thanks, Dan. I'll be happy to be back.
Yeah. We'll have to have you back, in 6 or 12 months and see where the world is by then.
All right.
Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. And he just gave them a dire warning. Mark says we're about to witness a historic stock market shakeup that could soon create devastating losses for investors who don't know what's coming. As a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history, and he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. If you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at www.rollingcrash23.com. He includes the name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of beloved pet brand Chewy before it fell 45%, tech company C Limited before it fell 66%, furniture company Wayfair before it fell 76%, social media favorite Snap Inc. before it fell 36%, and food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the famous FANG stock fell 35%. So you'll want to avoid the stock in his new report immediately. Again, simply go to www.rollingcrash23.com for your free copy of this new report. I think Alf is right that it's a little more important to be macro aware, and there's more macro uncertainty probably likely starting now and for the next several years. And some of my views about how I think the market's going to go sideways and things are going to be difficult, et cetera, et cetera. But it was good to hear. I don't know, maybe I'm too guilty of wanting to talk to people who I know agree with me on certain things. So, I don't mean to be that guy who's always looking for confirmation, but it does work out that way sometimes. And Alf agreed that 0% interest rates for so long was such a weird thing. But he had a very good way of putting it, though, didn't he? He said that it basically incentivizes people the wrong way. They become less productive. They allocate capital poorly. It's just bad for the world to make money really cheap and easy and to make investing look really easy the way it has been the last several years. And, what happens after that when there's a reckoning is not good. So, as I expected him to say, you need to play defense in your portfolio. But he also emphasized that you can have what he called your attackers. You can look outside the U.S. and, your defenders are gold, and he likes long bonds. But your attackers, one of his was Japan, which I sort of agreed with. So it's what Alf brings to the table is a really nice balanced viewpoint, I think, and a reasonable, rational one. The way he talked about the debt ceiling in terms of the probability being very low, extremely low that we default or get into any big trouble. But if the Republicans play brinkmanship long enough, we could be in a recession. So I hope you were taking notes. That was a lot to take in, but for me, it was really fun. I really enjoyed it quite a bit. And so that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and you know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_hour. If you have a guest you want us to interview, drop us a note at feedback@investorhour.com or call our listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.